let's go through the answers to the price to revenue exercise. So there's basically just three boxes to go through here. Before I get there, I want to show you one little thing here, which is, remember from the DCF exercise, right? We have these numbers flowing into here. Okay, we've got the bullish case, bearish case, and just right target price. Remember that was 22 bucks, right? And so the price to revenue numbers is going to feed into here as well. Okay, the target price that we come up with here, see there? And then next exercise, in the next section, we'll do price to earnings, and then we'll take an average of all three, okay? All three of these. And the reason we take an average is just to kind of minimize the margin of error if one of them is way, way off. And we never know which one it is. Okay, cool. So let's talk about the bullish price target, right? So recall with the DCF exercise, we had a bullish target, a bearish target, and a just right target, okay? Remember, Goldilocks and three bears. Okay, and let's kick it off with the bullish target price, which is 10 times revenue. And you can calculate it based on different years, right? It all depends on what kind of investor you are. Okay, some investors pick it off of the current year or the next year, but I prefer to look at it on longer term basis. And you can even discount it if you wanted to. Okay, so what is the bullish price target if we're at 10 times revenue in years 2019 and 2020? Okay, well, remember, hit shift first, then click. Then you can hit delete, take your finger off shift. Okay. And so what you do is this. You basically take 10 times the revenue in that year, right? And here, if you just click command and close brackets, it'll jump back to right here. See, I'm going back and forth? Right there. Okay, up here. All right, let's go back. And then what you do after you've calculated the market cap target, right? Then you divide it by the number of shares, okay? And the shares are just pulled right off the income statement, okay? Market cap divided by shares equals target price, right? And that is just right there, income statement, line 44. Let's go there. Let's check it out. There we have it. That's it there, okay? All right. So we're done with bullish. Let's talk about bearish. So a bearish price target would have a revenue multiple of, let's just say 5 times, okay? Shift click, take finger off shift, hit delete, okay. Oh, and by the way, here, you just do the same logic, but just for that revenue there, right? Okay, see, it's that times 10 divided by number of shares, okay. All right, in terms of bearish, you take 5 times, okay? 5 times the revenue divided by the number of shares there, see? That's just pull off the income statement. And by the same token here, for the price target, if you base it off of 2018, then what you do is you basically just take 5 times that revenue number, okay? And then you divide it by the number of shares to get the income statement. And then lastly, this box here, the just right one, right? So in the middle is just right, 7.5 times revenue instead of 5 or 10, okay? And then just by the same token, you're just going to take that times 7.5 and then just divide it by the number of shares. I think you get it. And then in terms of the target price I had here, I just discounted, right? That number of years until today. See? So the way I personally do it is I like to get my price target 5 years from now always, right? Because I love to ask myself this question. 5 years from now, is this company going to be more relevant or less relevant than it is today? And then you can kind of ignore the volatility in the middle and just kind of focus on 5 years out, because most people won't. Most people focus on 1 year, 1 quarter, next year, and there's a lot of volatility, and they get fooled by randomness. I want you to see the forest from the trees, okay? I want you to think to yourself, I don't know the path, but I know the destination is much higher or much lower if it's a short. And then again, you discount it by 4 or 5 years, and this could be 5 here if you're in early 2016, or it can be 4 if you're in late 2016. I don't know when you're taking this course. Okay, and then that will feed right into this guy here, okay? And that's the return to your target price there, okay? And that's basically that divided by the target price there. Okay, so you got 419% upside to this target price from here, okay? And that's the market cap today, okay? And then we've calculated the market caps in the future based on different revenue multiple and revenue numbers, okay? And then what we'll do is, you've got the PE exercise coming up next after this one. and then we'll take a blended average of all three. Okay, and then we'll get an average of all three there for our combined target price. And again, I love to look at least three different valuation methodologies just in case one is way, way, way off. Okay, cool.